Peter Dixon, global equities economist at Commerzbank. Peter, great to have you in the studio. Thanks for coming in. There's so much talk, of course. I mean, every day we talk about the debt crisis. Is America weakening? Is it a soft patch? Are we going to see a double-dip recession? What does it mean for an equity strategist? You can say it's going to be painful, but you can live with it.
Yeah, I mean, I think you've got to separate these two things because on the one hand, I would say that the debt crisis is, if you like, low-level background noise, low-intensity background noise. It's been there for the last 12 months, and it's going to be with us for another 12 months to 2 years.
Unless someone defaults. Is it fair to say that? Well,
I think that's a fair point, but I think the general expectation is that the European authorities won't allow a default to happen for at least another 2 years. So it's going to rumble on. So then let's look at the soft patch in the economy, which I think is probably far more relevant for how people are thinking about equities on a sort of week-to-week basis. Now, that clearly has the debate over that weakness has intensified over the past week, as you just mentioned. We had some pretty poor US data on Wednesday, and it's entirely possible we'll see another soft set of numbers from the payrolls this afternoon. I think under those circumstances, equity investors will be thinking, maybe this is the time to take a little bit more risk off the table, because obviously, if the economy is slowing, the earnings outlook isn't going to be quite as good as it has been in recent months.
But I wonder whether, Peter, a lot of investment strategists are actually also telling us that if there's a weak patch in the United States, or if we, have more and more concerns about the debt crisis somehow moving to the United States because of the debt ceiling, it means that a lot more people are going to get their money out of bonds, and therefore that should give maybe a short-lived boost to equities.
Well, I think you've got to ask yourself which bonds are going to be moving out of. To be honest, they're only going to want to move out of peripheral Europe. I don't think they really want to move out of treasuries. Quite frankly, there's not going to be an issue in the United States. They'll just push the debt ceiling further down the road. I mean, it's in nobody's interests to see a problem arising in the treasury market. So I genuinely don't think that's going to be the big issue. It sounds like a dramatic problem, but in reality, I don't think it is. No, I think the real problem is going to be in peripheral Europe, and I think that that's quite an easy one to avoid because you just buy German bonds, for example.
And so, what does it mean for your equity strategist? Do you stay away from countries such as Italy, Portugal, and Greece on the equity side of things?
Well, certainly we'd want to reduce our exposure to the European periphery. Yeah, there's no doubt about that. But I think equities generally still look pretty good, both in terms of their valuations and obviously in terms of the relative valuations against the bond market, where yields look really dreadful at the moment.
Peter, Nokia, this is something that, of course, we've been focusing a lot here on Bloomberg. It's almost like a Shakespearean tragedy. I mean, you look at the CEO, he's been trying his best. He hasn't really faulted anything. I mean, he's just been in the job for less than a year. Would you be buying the stock? It's had such a terrible week.
It has had a bad week. I mean, maybe there's a little bit more to go on that stock, to be honest. But I think, the further it goes down, the more attractive it becomes. I mean, the PE was trading at about 9.5 yesterday. Obviously, as the price goes down, that PE becomes more attractive, I think. So, yeah, there's going to come a point at which investors think, well, this is the point at which we want to buy into it. I don't think we're going to see a major rally, however. I think it's likely that stock will go down maybe a little bit more, stabilise. We might get a small rally, but, I think for the near term, at least, that stock looks to be trapped in a fairly low range of the cycle.
And do you like telecoms and techs in general, or are you looking at commodities, for example?
Well, telecoms, yes, because they're generally quite a stable, revenue generator. They should pay reasonably good dividends. Tech, I think, is going to be more vulnerable to the cycle, and if we are seeing a soft patch in the US, then that would certainly be a sector which takes a hit.
But what is your best advice? If I'm a new investor and I want to, I'm not really sure what to do with my stock, what advice would you give me in today's market?
Well, if you're a new investor, you've got fresh money, I would say overweight stocks. Generally look for stocks which are generally going to pay decent dividends.
So stable, the utilities, that kind of...
Absolutely. I mean, cyclical stocks, you probably want to underweight at this point. Commodity stocks, you would want to have some exposure, but don't overweight too much because simply...
Why? Because you're looking at China and you're concerned about what's happening in China, so you're expecting, what, a hard landing?
Well, I wouldn't say I'd expect a hard landing, but I think there was a risk that there's a lot of bubble in that market, which will come out on concerns that the Chinese economy is going to slow faster than we expected.
So what else would you be telling investors to be buying into?
I think you've got to have some exposure to emerging markets, obviously. I mean, but which ones? I mean, Asia is generally going to be a long-term winner. Yeah. I think a lot depends upon your investment horizon. If you're a long-term investor, buy Asia and stay with it, because it's going to go up, it's going to go down, but stay in it. If you're a short-term investor, you probably want to look more closely at places like Europe, or core Europe, I should say, Germany in particular, where the slowdown is probably less likely to hit.
Peter, what about financials? Because actually, if I speak to hedge funds, they're really split down the middle. The ones that say, yeah, it's a good time to get into it, and the others saying, no way, you'd be crazy to buy into them.
I think there's an awful lot of pain thing yet to come in the financial sector. I mean, we're seeing banks going through a capital raising exercise. There are credit constraints. They're busy rebuilding their balance sheets. And given all the legal environment in which they're operating, I think that's going to be very difficult.
Stay away from them. Peter, thank you. Peter Dixon there.